30-year U.S. Treasury yields have moved from a low of 1.69% in early December to a recent high around 2.2%. Now, most traders believe this move is being fueled by worries of inflation and a belief that the Federal Reserve will soon abandon its policy of buying bonds to keep yields low. As we often talk about here, rates don't live in a vacuum, and fluctuations in rates broadly affect other markets. Most in focus currently is the Nasdaq. It's a tightly held belief that growth and technology stocks are much more sensitive to rate moves because they're valued on future revenue expectations. Any move higher in rates today makes that revenue stream less valuable in the near term. Now, to put that in perspective, since early December, when the 30-year began its most aggressive part of its ascent, the Nasdaq has lost 7.5% of its value. Now, if a trader believes that the 30-year yields were poised for greater gains and wanted to trade yields or to potentially hedge a heavily weighted Nasdaq portfolio, an example of expressing that view could be to buy the CME January micro 30-year yield contract priced in simple yield terms at the current level of 2.17 and target pre-pandemic levels of 2.47, with a stop placed just below the psychological level of 2.00 at 1.99. This trade could make $300 if the target is reached, or risk $180 if stopped out at your level. Now, if a trader believes that the current move higher in yields is overdone, perhaps because pandemic pressures could soon force an economic slowdown and a pullback is near, they could sell that same micro 30-year at 2.17 and target 2021 congestion level around 1.90. A stop could be placed at 2.31. This trade could make $270 if the target is reached, while risking $140 if stopped out at your level.